This piece of the lecture is going to walk us through the strategic profit model. When we talk about the strategic profit model, it's the overall tool that we're going to use to assess the financial strengths of the retailers that we analyze this semester. The strategic profit model is a method for summarizing all of the factors that affect a firm's financial performance. So it's everything a retailer would need to know from a financial perspective rolled into one model. The appropriate measure for success for retailers, like we talked about in the introduction lecture, is not necessarily profit, but it's return on assets, because we really want to measure the profit that the firm makes relative to the assets it possesses. And so we're going to talk about how to do that through the strategic profit model. That's what the goal of the strategic profit model is it gets us to that ROA number. A goal for the retailer is to have a high ROA, like we talked about in the introduction lecture. The higher the better, because what we really want is to generate more sales dollars for every dollar that we invest into our business. And so our strategic profit model is going to divide ROA into two components of retailing: the net operating profit margin percentage and asset turnover. So retailers generally focus on one of those two measurement paths to work towards achieving the high ROA. So they either focus on the profit management path or the asset management path. And we're going to walk through both paths and talk about why a retailer would choose one over the other. But an operating profit margin, what that is a measure of profitability from the continuing operations of a retailer. It's a great predictor of future profitability. And asset turnover assesses the productivity of a firm's investments in its assets. So operating profit margin and asset turnover are both productivity measures that we use to get to our ROA. And ROA is determined by multiplying those two components together, the operating profit margin and the asset turnover. So both arms, both paths are very important. But oftentimes retailers do focus on one or the other. So that's what we're going to walk through today, is an example of the activities that fall within each path, the profit management path and the asset management path. And we'll discuss how a high ROA can be achieved through various combinations of activities through the strategic profit margin. So we're first going to talk about the profit management path. When we talk about the profit management path today and the asset turnover path, we're going to use an example of Costco and Macy's. And just for our purposes, this is the same example that's used in your textbook, so you can go back and reference that as well. After we get through this lecture, we're going to walk through a different example, so you'll have extra practice on how to calculate everything. But if you want to follow along in your book, or if you want to use this lecture to kind of add into the material that's in the book, we are discussing the same numbers, the same math from Costco and Macy's. So let's talk about the profit management path. All of the information we need to analyze the profit management path is located in the firm's income statement. So profit management path, income statement, they go together. The income statement really summarizes the financial performance of a firm or a retailer or a company over a period of time. And typically that is typically that's a quarter of a year, so every 3 months, or they look at the income statement 4 times a year. Sometimes the income statement is summarizing the performance of a year, and so that's what we're looking at today for Costco and Macy's. We're looking at their income statement at the end of the year, so an annual report. Let's detour real quickly into a discussion on why companies use fiscal years and not necessarily calendar years. You guys are going to have to look at the financial statements for the retailer that you're choosing to analyze for your partner project this semester. And so you're not always going to see an annual report or any other financial statement that's dated December 31st. And that's because a lot of companies don't work off of that calendar year. They look at a fiscal year. So think about this for a second. Why would an apparel retailer use a fiscal year of February 1st to January 31st? The reason might be if you're a retailer What time of the year is the busiest time of the year? If you said the holiday season, you'd be correct. So we're thinking October through December, right? Right before Christmas. Well, that's not actually correct. For retailers, that holiday season extends into January and sometimes even into February. And so that's why retailers, especially apparel retailers or consumer goods retailers, will extend their fiscal year through January 31st because they want to capture the end of the holiday season. And what I mean by the end of the holiday season is, when do consumers return the gifts they got for the holidays? Generally, that happens after the first of the year. Or think about consumers who get gift cards for Christmas or another holiday. When do they redeem those? It's generally not until January. And so retailers want to make sure that they are getting those sales and those returns calculated in the same fiscal year, right? So they'll extend their fiscal year to January 31st. Here's another example that I want you to think about, and you can express your thoughts and comments in the discussion boards. Why would a paint retailer use a fiscal year of November 1st to October 31st instead of a calendar year? So why would a paint retailer use a fiscal year of November 1st to October 31st? Think about that one and let me know what you think. All right, so now let's get back to our profit management path now that we've kind of had this detour about the income statement. So here's an example of the income statement for both Costco and Macy's. And again, this is the same one that's in your book, so you've got these numbers handy as we walk through some of this example math. So there are really, let's talk about the components of the profit management path and how we can find those things on the income statement. The first component that we have to have is net sales. Okay, net sales, let me see if I've got this on here. So there we go. Net sales are the total revenues received by a retailer that are related to selling merchandise. So net sales is not the same thing as net revenue or total revenue. Okay, net sales are the revenues received by a retailer that are related to selling merchandise. So a couple of things not included in net sales would be membership fees, credit card interest, or other special incomes that are listed as other income on the income statement. So you might see net sales on an income statement, you might see membership fees, which we do see on our example, or you might see other income. And all of that would be combined into our total revenue. The second component that we look at when we're measuring the net profit margin, the profit margin path, would be the cost of goods sold. Cost of goods sold is the amount that the retailer pays to their vendor or their supplier for the merchandise that they're going to be selling in the store. A third component that we look at is the gross margin. So when we're calculating gross margin, we have to also look at the operating profit margin. So in order to get the operating profit margin and the gross margin, we have to look at our operating expenses. And our operating expenses, or our SG&A expenses, those are used interchangeably, are our expenses that are associated with normal business operations, and they include salaries, utilities, office supplies, transportation, rent, etc. And I know we're walking through these quickly, but we're going to get to an example here in a second that'll kind of clear all this up for you. All right, so our operating profit margin is really our gross margin minus our operating expenses. So our gross margin is our revenue minus our cost of goods sold. Okay, and then to get our operating profit margin, what we do is we take that gross margin and we subtract out our operating expenses. Okay, and our operating profit margin reflects our performance based on our fundamental operations. So you'll notice that we haven't yet taken out, if we're looking back at that income statement, we haven't yet considered our taxes, our interest expense, or any other expenses that we might incur, because when we measure profit from a retail perspective, what we want to look at is our fundamental business operations and not other financial decisions regarding our taxes or our capital structure, any money we've borrowed from the bank. So this might be a little bit different than the way you've analyzed financial performance in the past, but from a retail perspective, it's imperative that we just look at that operating profit margin when we're calculating our ROA. Okay. So now we've talked about all the components that go into the profit margin path, and let's do an example. All right, so again, this is just a screenshot of what's in your book so you can follow along and go back and kind of fill in some blanks that the book might need for you. But when we're measuring our profit margin, when we're measuring our operating profit margin, and we're trying to calculate our profit margin path, here's kind of how we do it. We analyze 3 ratios to compare our retail performance. And the reason we use ratios is because no 2 retailers are going to have the same revenues or expenses or anything like that. So we can't just use their sales or their cost of goods sold or their operating expenses. We have to look at these ratios. All right, and so the first one is gross margin percentage. Okay, gross margin percentage. And so we take our gross margin over our net sales to get that number. Okay, so if we are looking at Costco and Macy's, let's calculate how we do this. So our gross margin is our net sales minus our cost of goods sold over our net sales. And remember, we're looking at net sales. We are not looking at total revenue at this point. Okay. So what's our gross margin percentage? For Costco, it's 10.5%. And for Macy's, you should have gotten 40.4%. Okay. The second measure that we look at are our SG&A expenses as a percentage of sales. So this is the second big ratio. Okay. SG&A expenses can also be called operating expenses. So we take that over our net sales. Okay. So for Costco, we know that our SG&A is 9.8%. Okay. We took our $9,518 over $97,062. Okay. And for Macy's, you should have gotten 9%. Or you take operating expenses, which is $8,281, and you divide that by net sales of $26,405. Let's look at the third one, our operating profit margin percentage. We take our gross margin minus our operating expenses over our net sales. So this is starting to combine. Okay. So if we take our gross margin minus our operating sales over net sales to get our operating profit margin percentage, for Costco, you should have gotten 2.9%, and for Macy's, you should have gotten 9.0%. Let's talk about some of these numbers, and let's analyze the differences between Costco and Macy's. When we look at our gross margin percentage, which for Costco was 10.5% and for Macy's was 40.4%, that number is down there on your screen right now. Why does Costco have more than triple Macy's sales, but Macy's has a higher gross margin percent? Why would that be? If you look at the sales number alone, it seems that Costco is greatly outperforming Macy's. But when you look at that gross margin percent, you can in fact see that Macy's is performing better than Costco. Well, think about how we calculate our gross margin percentage. We look at our gross margin over our net sales, or we look at sales minus cost of goods sold over sales. So margins are much higher at a department store, right? So if we look at our gross margin, right, we look at our sales minus our cost of goods sold. Our margin is much higher at a department store because people are willing to pay higher prices for items. When we look at Costco, consumers generally aren't willing to pay more, and so Costco has to lower their prices to stay competitive, and so they make a very small margin on the products that they sell. When we look at our operating expenses or SG&A percentages, and we look at Costco and Macy's, Costco has significantly lower operating expenses than Macy's does. If you look at your SG&A. Why does Costco have a lower SG&A percentage than Macy's? Think about what goes into the SG&A. Salaries, operating expenses. Costco has less customer service. They can pay their employees less because they offer less customer service. Macy's must pay their employees more because they have a higher level of service. When you think about rent, which also goes into SG&A expenses, Costco has significantly lower rent because they operate in low rent areas. They are a warehouse club like we talked about in Chapter 2. Macy's is a department store. They generally operate in shopping malls and have higher rent, which is going to drive up their SG&A. And so when you look at that as a percentage of sales, warehouse clubs will always have lower than department stores because department stores pay their employees more and pay higher rent. And so that leads to a percentage of sales that is significantly higher for department stores. Now let's look at our important number here, down at the bottom, our operating profit percentage. Costco has an operating profit percentage of 2.9% and Macy's has an operating profit percentage of 9.0%. What does this look like? Well, it looks like Macy's has almost 3 times greater than Costco, which suggests that Macy's is outperforming Costco when we look at our profit margin path. If you remember the profit margin path, the operating profit percent is the most important number that we look at. And so if we looked at the profit management path alone, Macy's is greatly outperforming Costco and therefore would be considered the more successful retailer. But we know as retail analysts that it's not just the operating profit percent that we look at. We also have to look at the asset management path. And the asset management path is what we're going to look at in the next section of this lecture.